I'm Greg Hunter. Welcome to USAWatchdog.com. Our next guest just wrote a killer piece on the five, actually more than five reasons why it looks pretty dicey this fall. I know. We've had record high after record high, but we've also had some big time money managers shorting the market like Jeff Gundlach. We've had also Paul Singer, and also another big time analyst, money manager, warning about the global catastrophe. And my next guest is also warning. He is money manager and analyst Michael Pento of Michael Pento Portfolio Strategies. Michael Pento, thank you for joining us today on USAWatchdog.com.
Always a pleasure to be back on with you, Greg.
Well, I wanted to start. I'm gonna jump around on the list because I want to hit the one of the things you brought up, and lo and behold, Kim Jong-un in North Korea just fired another ballistic missile, and it fell into the Sea of Japan. That's one of the reasons why you think things may get pretty dicey this fall. Could you start with that point right there?
Yeah, last week, I think it was Friday morning, Kim Jong-un fired another ballistic missile. This one not only landed in the Sea of Japan, but it landed within the territorial waters of Japan. So this is a big provocation. I think Donald Trump, on the heels of his failure to get the Senate to do that skinny repeal last week, I think he's looking for a victory, looking for a win. And I don't think anybody, Democrat or Republican, would balk at the idea of doing something to fetter Kim Jong-un's progress towards delivering a nuclear missile to the United States.
Where it gets dicey, I guess, is China and Russia. China acts like they want to try to do something. I mean, 90% of North Korea's trade is with China. Russia also has a little piece of border on, North Korea's northeastern border. But could that turn into a wider war? Is that why you're saying that this could shake the markets?
Well, it certainly could. First of all, Russia just had sanctions renewed against them last week. We seem to be enamored with the fact of finding an enemy in Russia and can't find any kind of common ground with them at all. China and Russia are the big trading partners with North Korea, but you don't need them involved in a war. The United States and North Korea alone, if Trump was to launch a preemptive strike to take out Kim Jong-un's missile battery silos, then that would be enough to send the stock market down. I'm not predicting it. I'm just saying it's a scenario that's becoming more and more probable as we head into the fall.
And what about, let's go into your other thing. We'll take them in order now, maybe a little bit more order because it just happened last week, the Kim Jong-un thing. The number one reason, especially with this little debacle, McCain killed Skinny, that the debt ceiling, that's not a done deal in your estimation. That we could have a real problem with Congress getting together for that, right?
Well, let's just paint a picture of why I think, and let's be honest now, I've been cautious about the stock market since 2014. And the reason why I was cautious about the stock market is because I firmly believe that money printing, massive counterfeiting on behalf of the Federal Reserve of the United States caused the stock market to go up multiples higher than it would ordinarily be. And I always point to the total market cap of equities as a percentage of the economy to illustrate this point. We have been around 55%, that ratio, total market cap to GDP, for decades, forever in the stock market. We are now at 135% of the underlying growth of the economy in the United States. That is an untenable situation, and it never lasts long. And I can tell you, I can promise you, that this is a very, very dangerous market. And I've been cautious, haven't been short the market. I've been cautious since 2014 because that's when the Fed ended its QE program. But guess what happened? Right around that time, when the Fed terminated its QE program, its $85 billion per month counterfeiting program, the ECB, the European Central Bank, started printing 80 billion euros per month. And guess what also happened right around that time? The Bank of Japan started counterfeiting 80 trillion. They ramped up their QE program to 80 trillion yen per annum. Let me say it again. You think about the value of a dollar or the value of a yen, 80 trillion of this confetti. is being printed since 2014 on an annual basis. Is it any wonder, Greg, that there is no volatility any longer? That the VIX index was down to an 8 handle last week, an all-time record low, never before seen? And it seems like we've gone for ages, and it has been a very long time since the market corrected 10%, and certainly been even longer for a 20% correction. We're way out of bounds on that dynamic.
I think your article, I think you brought up 350 days, more than a year.
And what's the normal time frame? My article talks about how far removed we are from the normal time frame and how long it's actually been. So what did that do? What did that quantitative easing do on the part of the ECB, and you can throw in the Bank of England there too, and the BOJ? That took interest rates, which were much higher than normal, especially in Europe. If you look at the Greek 2-year note was 240%. That was the interest rate bearing for a Greek 2-year note. So Mario Draghi came in, the head of the ECB. He printed up money. ECB, BOJ, they took $14 trillion worth of sovereign debt and put a minus sign in front of it. Now, if you put a negative sign in front of sovereign debt, that forces people into the broader equity markets. 14 trillion. And I will tell you this, right now that went from 14 trillion down to just 6 trillion. And the reason why it's down to $6 trillion worth of negative yielding sovereign debt right now is because the Fed ended QE, and guess what? The ECB is going to start tapering quantitative easing. They're going to announce that on September 7th. If I'm right, and this is what I really believe to be the case, September 7th will be the official announcement of when Mario Draghi and the ECB will start winding down QE. They already took it from 80 billion to 60 billion. He's going to lay out a timetable. And on the heels of that announcement, on September 20th, that's the Fed, the FOMC meeting, I think Janet Yellen is going to announce the official date for quantitative tightening, or I call it reverse QE, when the Fed starts unwinding $4.5, well, not going to do all of it, but the balance sheet is $4.5 trillion. They're going to take it down by at least, in my opinion, and many others that analyze this Federal Reserve, at least $2 trillion worth of the unwinding of the Fed's balance sheet. That's going to start in the fall. So you have North Korea, you've got the ECB, and you've got the Federal Reserve. And even the Bank of Japan has, the people in Japan are fed up with a declining value in their currency and a 1% handle in GDP growth. So even the people in Japan are going to throw back Mr. Abe's arrows, and even they are going to start reducing quantitative easing.
Well, renowned money manager Paul Singer, I think he must be listening to your interview, said that almost identically the same thing you did. He said, when people lose faith in the central banks, and so far they haven't, but he suspects they'll lose it, and when they do, they'll lose it quickly. And that's going to really roil the bond and the stock market. The bond market, he brought up the bond market too. You think we could have a pretty heavy meltdown if they, oh my goodness, they're stopping all this. I mean, that's what's floating the market. That's what everybody knows. That's what's floating the market. I mean, without it, where does the market go?
Everybody that is objective and honest, that doesn't have an agenda they want to follow, understands that printing trillions of dollars out of thin air from nothing and buying mortgage-backed securities and sovereign debt, and then those banks, those primary dealers, take that money, that credit, and what do? They gamble in Wall Street. They gamble in the Mibtel in Milan and all the other exchanges throughout the world. That's what they do. So that has caused volatility to fall to an all-time low. It's taken the total market cap to GDP to a near historic level outside of a small window in 2000. And when that ends, I wrote a book about it called The Coming Bond Market Collapse. I wrote it apparently about 2 years too early, but I never dreamed that someone would loan a government money and be guaranteed a loser. I mean, when you loan somebody money, you actually want to get a real return, inflation-adjusted return, and a tax adjusted return, a positive return. You're guaranteed to start out as a loser. And what makes these matters worse is that all of these central banks have universally adopted a 2% inflation target. So if you're guaranteed to lose principal and then you have to add negative 2% on top of it, who else besides a central bank is stupid enough to join into that deal? So that's when I know for sure that when central banks remove their thumb from the scale on the prices of bonds, they will crater and yields will soar. For instance, in the case of Europe, we've got in Germany, we have a German Bund at 55 basis points with a 2% inflation target and a 1.5% to 2% growth rate. That makes nominal GDP close to 4%. If nominal GDP is 4%, and that's where the 10-year has always traded throughout history in every country it's measured, what is a Bund doing at a half of 1%? That's going to rise very rapidly. And I'm going to tell you, when you have an economy, we just learned last week that the first half of 2016 GDP grew at a 1.9% annualized rate. So we're actually not able.
That's 2016 or 2017?
2016
okay.
was last year.
Right.
That was last year. The first half of 2017, we just got it on Friday last week. We just learned that the economy grew at 2.6% in Q2. It was downgraded to 1.2% in Q1. That's 1.9% annualized growth. So we're falling below 2% in this country. If you start raising dramatically the borrowing costs, and I'll tell you this, the housing market was down month over month in June, and existing home sales were up just 0.7% year on year, Greg. 0.7%. You start raising the cost of mortgages dramatically, which has to happen, because the Fed's going to be selling these or letting these treasuries and mortgage-backed securities roll off their balance sheet. And when they do that, they add to the supply. Supply of debt is already growing 31% year over year. That's the Treasury Department's own numbers. So our deficit is up 31% year over year. You imagine if we're going to add trillions of dollars to the pie of bonds that has to be purchased? Who's going to buy them at these levels? No one is. So bond yields are going to rise, prices are going to fall, and that's going to send the already rolling over housing market and auto market and student loan market and credit card debt market very much into a plummeting toboggan slide.
Well, what about the derivative market? I mean, you start getting a big spike, and everybody has been betting that this is going to be nice and calm, and they bought all these 0% bonds. Like to your point, it was, I don't know, 13, 14, 15 trillion of that junk, and a bunch of stuff, the 10-year treasury at 1.5 and 1.7 and 1.8. I mean, there's all kinds of debt out there that's very cheap, that's fairly long dated. What's going to happen to the derivatives?
Multiple hundreds of trillions of dollars in credit default swaps have been bet and placed their bets that interest rates are never going to rise. Think about AIG, selling insurance on mortgage-backed securities because you're never going to have to pay on that insurance because home prices never go down. Well, you're never going to have to pay off those bet on those credit default swaps because guess what? Interest rates are never going to go up. But guess what? I believe in mean reversion in science, in physics, mathematics, and in economies as well. Interest rates will rise. They will rise when central banks remove their thumb from the scale. And that's going to bring chaos throughout the entire global stock market.
And a lot of people, you know more about this than other people, but most people don't talk about the derivatives complex. You were saying hundreds of trillions of dollars. That's going to swamp the market. There won't be any central bank. All of them together couldn't stop an implosion of hundreds of trillions of dollars of derivatives, could they?
See, the central banks are following they're not stupid people, I believe, but they're following these stupid models. The models are all spurious in nature. So they have this Phillips curve model of inflation, and they have to keep raising interest rates because, oh my God, too many people are working, and that's prosperity, and that's going to cause hyperinflation. I would like them to point to one example in history where an economy hyperinflated due to people working. Imagine the hubris and arrogance of a central bank that actually says that I have to limit the number of people who are employed. The people that sit on the FOMC have jobs, they feed their family, but they're saying that the certain group of individuals who cannot be allowed to find gainful employment because that leads to hyperinflation. So my point is that the Federal Reserve is, and also the ECB and the BOJ, less so the BOJ, but certainly the Federal Reserve, they're going to start quantitative tightening, and it's never their opinion, because of their flawed models, that they're going to lead to a disaster. But I'll point to 1998 to 2000, the Fed raised rates from 4.5% to 6.25%. And we know what happened in the year 2000. The NASDAQ lost 85% of its value. We know what happened from 2004 to 2006. The central bank took rates from 1% to 5.25%, and it was very orderly and very calm. And every moron and bobblehead on TV assured you that the Fed was in control and wouldn't do anything to disrupt the economy or the stock market until we hit September, October of 2008. Actually, the market was going down for a whole year before then, but the bottom fell out of the economy at that time. And they're doing the same thing now. They've been tightening since December of 2013 when they began their taper. They've raised rates 4 times after consummating the taper. Now they're going to start reverse QE, probably in October. And I'm just saying, I'm not saying short the market yet. I mean, I run a portfolio where the model portfolio is doing okay this year. We're not just always buying 50% of the portfolio isn't in gold and 50% isn't short the market all the time. But we're trying to get that timing right. And I wrote this piece because I firmly believe that the fall has a myriad of issues, and those myriad of issues will really affect the derivative market, the credit markets, completely could shut down the credit channel, and that's what I'm most afraid of in the fall. And you have a stock market now where you have gamblers that have all kinds of algorithms and derivatives that are geared towards selling. I'll just give you one example: selling naked puts. In other words, they are in the market saying that if XYZ is at 100, I'm going to sell a put at 95. And then they collect the premium because the stock market never goes down. They just collect premiums on top of premiums. Well, as volatility falls down and down and the premium shrinks, they go closer and closer to that strike price. So the stock goes from 100 to 105. Now they're selling the put at 103 and 104. Well, if the stock market goes down, that triggers that panic. They have to unwind those positions, those derivative positions, in a panic. And ETFs that are owned on leverage, I'll leave you. I'm talking too long here. I just want to say one more thing before you ask another question. I will say that the cash levels, I want to remind our audience, cash levels are at an all-time low on institutional balance sheets for the stock market, and margin debt is at an all-time high. Now, if that doesn't scare you coming into the fall, I think you really need a wake-up call.
Is this set up different than 2000 and 2008? In other words, they had these fairly big couple of 100 basis points interest rate rises, going into the crash at least. And but is this a little dicier? In other words, that you don't need that much of a raise in interest rates. You don't need the same raise you had in 2000 or the same raise you had in 2008. Leading up to that. Is this a little dicier?
Of course. I'll make my point very clear. So, Fed raised rates from 1% to 5.25%. So that's 425 basis points. We only raised rates here 100 basis points since the Fed started raising rates in 2000, and I think it was 2015 was the first December 2015, I believe. But we're in a different paradigm now. The template's been changed. When was the last time the Fed bought $3.7 trillion worth of long-term debt and then stopped buying that debt and then started to sell that debt?
That's a good point. Maybe never.
You don't need, so we only have, Michael, we don't need 400 basis points or 200 basis points. You only have 100 basis points. But now you're starting to unwind trillions of dollars worth of mortgage-backed securities and treasuries. And once that goes full speed, if you have the ECB taper and the reverse QE, sometime and I think it's going to be the fall, but for sure. And if this doesn't happen by the end of 2018, I'm going to close down. I should never say this, but I'd be probably better off selling hot dogs outside of the stock exchange than running a fund, a separate managed account. By sometime during 2018, the Fed and the ECB and the BOJ will most likely be dumping way more treasuries than ever before possibly imagined.
Well,
And
if they don't dump them though, let's get into why. If they don't dump them, and interest rates go up, and they're holding this big ball of garbage, aren't they going to be insolvent?
the banks are already the leverage ratio on the Fed is so small. So this risk-free debt that they hold, whenever they do hold, they're going to send the prices down, yields up, and their balance sheets will be, they'll be definitely bankrupt. But the point is, and I wrote about this many years ago, if a central bank is insolvent, does it really matter? Because they have, like Al Capone did, has in the basement, they have a printing press. So they can always just print money. It's the problem is going to be if the market, and I'll just say, I want to say when the market understands that central banks have lost control of the money supply and the monetary base, and that's coming. When that happens, you will see a currency crisis, and not the dollar necessarily cratering against the yen, although it's happening. Dollar index is at 93 and ready to break lower. It's the faith in fiat currencies that's going to cause panic in asset classes, and I don't mean the dollar against the yen. I mean fiat currencies against gold. That's what's going to happen. Fiat currencies vis-a-vis hard assets. That's going to bring inflation to much higher rates than we ever even dreamed of, and much higher than the Fed's and central banks' phony and arbitrary and capricious 2% target.
Gold has really caught fire the last couple of weeks. I mean, last week it was up. Friday it was up big time. Is that what big money players are doing? Because mom and pop aren't walking down to their local coin shop and buying 2 gold eagles or buying 10 silver eagles. So big money is buying into gold and making it move up, even with the suppression game that is clearly, and they admitted to, has been going on. Tell me about your thoughts on gold and and the action that you've seen in the last few weeks.
Well, I think it's setting up for a huge spike higher. I don't think the time for it to start is exactly now, although I can tell you that the gold market is catching a bid here. The big boom in the gold mining price, the gold price and gold mining shares is going to occur when that watershed moment comes, when we realize, the market realizes en masse that central banks have lost control of the economy and the money supply. That is coming very, very soon. And I see very, very soon. I mean, before the end of 2018, probably in the middle of 2018 at the latest, and it probably could even happen this fall. That is when I think the market understands that central banks don't really control interest rates. They cannot control the long end of the yield curve, and they will destroy economic growth and stock markets across the globe. That is the big moment when you want to pile into gold. If you don't have any gold, you should have at least 10% always. That's your base level. But there will be a time when I think gold mining shares will rip higher, and that time will probably be 2018.
Well, won't some of these guys be just looking for anything tangible to get into to preserve their paper wealth? I mean, won't they be looking to get into almost anything? Well, with the exception of stocks and bonds, they'll be getting anything physical is going to go through the roof, right?
Hard assets will go through the roof. That is my prediction, and it won't be Bitcoin either. That's the beauty of gold. It's extremely limited in supply, and it's virtually indestructible. And those 2 points make it perfect money. And neither of those 2 attributes can be said about any digital currency. So they'll be flocking to gold I think it's going to go, I think by sometime in 2018, gold will be well on its way to an all-time record high. Now the timing's got to be right. Right now I'm a little bit underweight gold because, again, when do you want to own gold? When the fiat currency regime is under extreme duress and real interest rates are falling. Right now, the fiat currency regime is starting to crater, especially when it comes to the dollar. But real interest rates are going to be rising. in the short term. So gold is going to, it might be a little volatile, and you can tell, after that debacle in 2000 and gold mining share debacle in 2015, you have to be very, very careful when you overweight your gold exposure. But it's going to change. I think we take out the old highs sometime in latter part of 2018. I want to add this one point too before I forget.
Sure.
I want to also touch on the inverted yield curve in China. So when a yield curve inverts, it always presages an extreme amount of duress in the banking system. That's what happened in the year 2000. That's what happened in the year 2006 in the United States. It was a little bit of a lag before we really learned how pernicious it was going to be. But the yield curve in China inverted for the second time since 2005. It inverted very, very recently. So China is in a lot of problems. You have the inverted yield curve. You've got North Korea. You've got dysfunction in D.C. I think Trump is and again, I voted for the man. I was rooting for his success, but he seems to be drowning in the swamp instead of draining it. And a lot of self-inflicted wounds there. The inability, Greg, of Congress, it's not all Trump's fault, the inability of Congress to repeal and replace Obamacare, and the fact that the border tax adjustment is now off the table means, and I said this from November of last year, it means that the tax cuts will be diluted and delayed, and further diluted and delayed, because they're starting from a much higher base. They can't get rid of those taxes in the ACA. And the border tax adjustment was a great way to pay for, or at least a way to pay for a 15% corporate and pass-through tax rate. That's not going to happen. So you're looking at 15% to 28%. That's probably where corporate taxes will go. And that was really the last lifeline that the stock market was clinging to. So you had the hope of a massive tax cut, and you had unbelievable, humongous, gargantuan quantitative easing from central banks. All those things are going away. And September 7th, September 20th, and the middle of October, very, very crucial times in the stock market. At least if you're not going to short the market, I probably will for my clients. If you're not going to short the market, at least raise some cash for the fall. You'll probably thank me in the end.
And then you are a money manager, so you have a different type of investing that most normal people wouldn't do. But you're just saying, just for the normal Joe, have 10% in coins, have gold coins, silver, I guess silver as well. Have some of your money just sitting as a core investment, nothing fancy. Just let it sit there and be able to hold it. Is that right?
I would say at a bare minimum, you should have 10% of your holdings in physical gold and silver that you have possession of. That's your base. That's your baseline. And as a portfolio manager, I could see myself going to 40 or 50% gold mining shares and other gold-related proxies in sometime in 2018. It's not the time yet, but those, as you and your audience is probably aware, when gold rips higher, you have that leverage in mining shares, so you really want to take advantage of that.
Okay, Michael Pento, Pento Portfolio Strategies, the article, which I will link to for you guys on YouTube. Just click back to the, all links are found at USA Watchdog. 5 reasons to fear the fall. Very well laid out. Very extremely well sourced and laid out. Good analysis. Michael Pento, Pento Portfolio Strategies. Thanks for joining us today on USAWatchdog.com.
Thanks again, Greg.